friend speak to us today. He is Professor of Economics and Chairman of the Galliot Center for Public Policy here at the Tepper School. And he comes to us with a very rich background. He was Senior Vice President and Policy Advisor at the Federal Reserve Bank in Richmond from 1993 to 2005, where he served as the Principal Monetary Policy Advisor to both the bank president and also attended numerous meetings of the Federal Open Market Committee and the Federal Reserve Board in Washington, D.C. So he's had that experience, a close colleague of Dr. Meltzer. He's also published widely on monetary policy and related matters. Some of his more recent papers, like Inflation Targeting in the United States, appeared in the 2005 book, The Inflation Targeting Debate, edited by Ben Bernanke, who you all know, and Mike Woodford. And a 2006 International Monetary Fund Policy paper on a framework for independent monetary policy in China was widely read throughout China. So he's fresh back from a trip to India. He's been speaking a lot, doing a lot of research, and has lectured at high-level policy commissions and conferences throughout China and India, and he's back here with us today. He was this summer a visiting scholar at the Federal Reserve Bank of New York and the Federal Reserve Board in Washington, D.C. So handpicked by Dr. Meltzer to come back and be a part of the team here at the Galliot Center. We're delighted to have him on as one of our young and exuberant faculty members here. So join me in welcoming Dr. Marvin Goodfriend.
Is this on? Okay. Thanks, John. Well, I don't know about the young part, but the exuberant part I'll own up to. Before I begin, I want to mention that if you have Alan Greenspan's book, there's one picture of Alan Greenspan in the Federal Open Market Committee in that whole book. And if you look closely, I'm sitting right behind him. That's my claim to fame. The best story about that is that my mother and sister were watching television when that book came out, and they put that picture on television, and I hadn't seen the book or the picture, and they called me up and said, "Is that you? You need a magnifying glass," but it is me. So I want to talk today for about 20 minutes on an overview of monetary policy in East Asia. It's a paper that I was asked to write for a Bank of Japan conference in May, and it's a very good kind of overview of issues in many of the countries in East Asia, not India, which is South Asia. I'm happy to talk about India after my introductory remarks. I just came back from India and really learned a whole lot more than I knew earlier in the summer. And so what I hope is after doing my 20 minutes, you all have plenty of questions so that we can engage in Q&A for the balance of the hour here. Okay. This is going to be more or less a helicopter overview of a lot of common concerns. They involve 5 areas. The fact that this region is heavily export-oriented. The region has highly integrated regional trade, where those countries that have cheapest labor process goods, they put goods together, and those countries with highly skilled labor originate the highly skilled components and so forth. The region is famous for that. There's also another feature of the region which is important for monetary policy issues, and that's the fact that it's very bank dependent. This is not a region that has well-developed internal capital markets. Most all intermediation goes through the banking system, and that has consequences for monetary and banking policy, as you can imagine, and exchange rate policy, I might add, with respect to China. I'm going to come back to that in a minute. This is a region that has potentially highly persistent trade surpluses, which gets a lot of attention and is creating problems for the United States. And I want to talk about how they are related to monetary policy. And finally, this is a region which is famous for accumulating international reserves. If you're an aficionado of this kind of thing, this region, China has over $1 trillion of international reserves that it's accumulated and is continuing to accumulate at a breakneck pace. That's where most of our U.S. Treasury debt goes, by the way, to the Chinese to fund our various activities here, including the war and other government spending. And so there's a question about whether that will continue or not. Okay. I'm going to go relatively quickly through these slides, and I'm going to skip the first bunch, which are rather technical and have to do with the theory of monetary policy that says that inflation targeting is a good idea. You may have heard John mention briefly that I was asked to do a paper for a book by Ben Bernanke. Ben asked me to write a paper, Inflation Targeting in the United States, which used U.S. experience to make the case that the U.S. ought to have an inflation target. You may know that Ben Bernanke got his job as Fed chairman being an advocate of an explicit inflation target for the United States, something that Alan Greenspan was not in favor of. Nevertheless, Ben Bernanke got the job as an advocate of that, and for the last 2 years, the Fed has been having intense discussions internally about whether to move forward with an inflation target. In the interest of time, I'm not going to go into the theory underlying Ben's views, which happen to be my own views, that we ought to move to an inflation target, in part because it's just too much. It would take a whole hour. But I'd be happy to talk about that with you later on. Let me skip immediately to this key issue with respect to East Asia, which is the exchange rate regime. Most countries in East Asia now have a flexible exchange rate. China does not. And so this next couple of slides should be taken to apply to China. And this is a problem of having a fixed exchange rate vis-a-vis the dollar. First of all, East Asian development has historically improved the terms of trade against the West. So, for example, the Japanese real exchange rate has improved by 300 or 400% in the past 30 years. It's the poster child for what happens when a country moves up the value chain in producing goods for export to the West. If a country sustains a fixed exchange rate during that transition, then it has the following problems, which I want to outline, which are problems, by the way, that I would suggest that China has as we speak and will have for the next few years, because it's essentially fixing its exchange rate against the dollar. What happens is countries that are seen to be developing successfully have what I've dubbed excessive export optimism from time to time. Markets are exuberant from time to time. And in East Asia, there's, for good reason, optimism about the ability of those countries to develop and improve their terms of trade against the West. That has the following consequences. In the third bullet point, well, East Asia borrows from the U.S. And runs a trade deficit ordinarily. In China's case, it's been able to avoid doing that because the people in China save an incredible amount relative to income. We can come back to that later. But nevertheless, in the system, there's a tendency for countries which can expect to improve their terms of trade over time to try to borrow and invest a lot domestically and run a deficit relative to the U.S. In China's case, that deficit is invisible because there's such an overwhelming surplus that's due to China's savings. Well, what happens is, and this fourth bullet point is evident in China, given home bias in consumption and sticky prices, what happens is East Asian country which sees itself developing rapidly and is optimistic about exports, it has its employment rising, its wages are rising, its business markups get compressed, and all this is happening in China. It's having inflation, all because the exchange rate is fixed. And what's going on there is that as the incomes in yuan rise, as inflation rises in China, this is how Chinese purchasing power over U.S. goods is moving up, in spite of the fixed exchange rate. In other words, by fixing the exchange rate, China is generating domestic cost and price pressures, which are the manifestation of a rising terms of trade, rising income in China relative to the U.S. The problem is, what if export optimism proves excessive, as happens in markets all the time? There's excessive optimism and pessimism. Currently, we're in a wave of excessive optimism in China. I would say, and when I teach my MBAs, I say, I'm not a marketing professor, but I think one of the most successful marketing programs in world history is the Communist Chinese marketing program of what I call the inevitability of China. There's not anybody in this room, I bet, maybe there is, and I'd be happy to see it, who expects a Chinese recession in the next 3 or 4 years because of an overheating and a collapse of the sort we see many times in the West. I happen to think that there's a good chance of that happening, and you'll see why after a few more slides. Chinese have marketed themselves as inevitably inevitably moving ahead with very little chance of recession. Well, the problem is, as East Asian price levels adjust upward in lieu of an exchange rate adjustment, that exposes the country to deflationary pressure if export optimism proves unfounded. So suppose the country gets a little ahead of itself, which is already happening, I think. We have a stock market valuations in the Shanghai market, which everybody agrees are way, way beyond what's sustainable. And what happens, and I believe this will happen likely after the Olympics in August, it's inconceivable that the country will try to put the brakes on before the Olympics, but after the Olympics, all bets are off. I'm not even sure what private people are expecting to do after the Olympics, let alone what the government is expecting to do. So we'll wait a year or two to see whether the chickens come home to roost on this. In any case, by that time, you'll have had some inflation in China. And if then the country realizes that it's gotten a little bit ahead of itself in terms of optimism, there'll be a kind of a ratcheting down of business activity. The problem is, at that point, the terms of trade will have to reverse somewhat because they've gotten ahead of themselves. A reversal of the terms of trade with a fixed exchange rate requires that the price level, the yuan prices of things in China, they have to come down. That's called deflation. And anybody that knows anything about macroeconomics knows that deflation, a collapse of the level of prices, not a rate of change of prices, that deflation inevitably carries with it unemployment, recession, and sometimes extremely serious recessions. The problem with China is, as far as I can tell, it's headed in a couple of years for a situation that's almost certainly going to involve some retrenchment with the potential for deflation and a potential recession. The problem is, at that point, China has other options. It can devalue the exchange rate. It doesn't want to do that. Everybody's thinking in terms of a revaluation of the yuan. But in 2 or 3 years, if the country gets hit with a potential deflation of domestic prices because of a prior inflation, it's very possible that the Chinese yuan would have downward pressure on it to avoid the deflation domestically and to bring down the terms of trade by devaluation of the exchange rate. So China is a very complicated situation. And this, I wanted to bring all this up initially in the discussion today. We can talk about it later in the Q&A. Main point is, this is not a country, I think, without what we call credibility problems. People that understand what's going on think that China has credibility problems with respect to its macroeconomic policy, its exchange rate policy, and so forth. The second item I want to talk about is something that applies more broadly in East Asia. It has to do with potential financial cooperation among the countries in East Asia. And it starts with the idea that the International Monetary Fund is not doing very well these days. For all kinds of reasons that I'm sure you're aware of. The International Monetary Fund has run into reputational problems. And now that many of these countries in East Asia have tremendous amounts of international reserves, they don't need to borrow from the International Monetary Fund very much. And what they're doing is trying to organize themselves into their own East Asian financial cooperative to kind of opt out of this International Monetary Fund group, if not explicitly, implicitly, and manage their own financial affairs closer to home. It's understandable that they would do so. This is the part of the world that's growing. And it's also evidence of the fact that the United States' influence over the world economy is waning, in the sense that it's the United States that set up the International Monetary Fund, or led the setup of the International Monetary Fund after World War II, and these countries are finding that they really don't need it. So what I want to talk about now is, what's the economic rationale for an East Asian credit union? And that's what it is. I mean, we think of a credit union as largely having to do with individuals working for the same company and sharing a bank because they all work at the same company. And a credit union is a good idea because if you want to borrow from that credit union, it's a pretty good bet that you're going to pay back your loan. Why? Because you can be fired from the job at the company credit union if you don't pay back your loan. A credit union is a good thing for individuals to get into to reduce the cost of financial intermediation if you already have a prior association that you can exploit to do so. So I want to talk a little about, is there a prior association in East Asia that makes an East Asian credit union, if you will, or a credit cooperative, or whatever you want to call it, a good idea? So a credit union accepts deposits from and makes loans to eligible members, bullet 1. The members share a prior association. The credit union economizes on evaluation of creditworthiness. It monitors loans and enforcement, and it enforces repayment, making use of all this information that we know about each other. It always puts a share of its assets in liquid reserves in case somebody needs an emergency loan. In fact, there is a credit union at Carnegie Mellon. I just joined a couple of weeks ago. And the credit union advances funds on short notice because it understands the circumstances of its members. It pretty well can tell if somebody's coming in with a story that doesn't make any sense. We all know each other. It's a good way to do financial intermediation. Most of us have our funds in the union and don't need a loan, but occasionally we need a loan and we take out our money and we put the money back and so forth. And the money kind of circulates around the members. And that's what it would do in East Asia. So the East Asian financial cooperation rests on an analogy to a credit union. And I don't mean to belittle this, even though we're talking about a bunch of countries. One nice thing about economics is you don't shy away from analogies that make sense, even if it belittles this idea of a East Asian monetary fund, or so to speak. So what do these countries do? Well, they interact regularly due to proximity. They have common export orientation. They have regional integration in trade and finance. And they do have a number of intergovernmental relationships, and they are in touch with each other all the time. They can exchange information and implement surveillance on the basis of this common association. And it sounds like a credit union is feasible, and I believe it is in East Asia. And the last bullet point just says that the scope for regional credit cooperation, such as bilateral foreign exchange swapping or having some generalized financing facility, makes sense in East Asia, at least in a first pass. Now, having said that, I just talked about the virtues of a flexible exchange rate a minute ago. And it's important to know that there's no way that a country should not have a flexible exchange rate, period. It may be possible for East Asian countries to also, on top of that, have some credit cooperation. The two are complements, they're not substitutes. And to the extent that you see people in East Asia arguing that we want financial cooperation so that we can fix our exchange rate to each other and eliminate exchange rate flexibility, I think that's a terrible idea. And I would say some portion of discussion of the East Asian Credit Union or monetary fund idea is predicated on the idea that some government officials would like to have fixed exchange rates throughout the region. I think that would be a disaster, especially in a region that's transforming itself rapidly into a developing world, a developing economy. So you have to distinguish credit policy from interest rate policies. And you can do that. This is a technical point because interest rate control is really independent of credit policies. Sterilized borrowing of international reserves to finance capital outflows can be done without the disruptive adjustment of interest rates or exchange rates. They're two separate policies. What does a credit union do? Essentially, it allows governments to buy time before resorting to interest rate or foreign exchange actions. And so whether buying time is a good thing or not really depends. It depends on whether or not government has information on duration of capital flows that markets don't have. So to the extent that government officials want to engage in an East Asian monetary authority, and they want to do so they can finance balance of payments fluctuations without having to move their exchange rates around, if governments do that, we have to make the case on the basis that governments know something that markets don't know. That's a very, very hard case to make in this day and age. And I'm a little suspicious of that kind of motive. On the other hand, it's even worse because this East Asian Monetary Authority could be counterproductive and expensive if borrowing international reserves blunts adjustments that turn out to be necessary after the fact. If you just buy time and eventually have to let your exchange rate adjust, you have to repay these reserves to another member of the East Asian Credit Union. It could be very costly. It's true that this kind of arrangement could deter a speculative attack on a particular country and prevent it from spreading around the region, and I think that's true. But, and this last bullet point is a little technical, but something very important. To the extent that this East Asian Monetary Authority operates, as we're describing, these benefits could be offset by providing, this is delicate, deliberate, and unfortunately pedantic language, by providing non-priced incentives for investors from the West to move capital into the region on short-term rather than long-term basis, with the expectation of a quick reversal financed by borrowed reserves from the East Asian Monetary Authority. In other words, the East Asian Monetary Authority would essentially be providing insurance free for Americans to move into the region on short-term basis. We all know that free insurance sounds great to an individual, but it's a disaster for government policy. It's a disaster when you have deposit insurance that's underpriced within a country, and it's equally disastrous if you're providing insurance for international capital flows that can essentially allow them to exit without paying a price. So even if this thing goes through, it still has what we call a moral hazard associated with it. So where do I stand on that? I'm happy to have a relatively marginal East Asian Monetary Authority in place as long as it doesn't interrupt the necessity for exchange rate adjustments and it doesn't get so big as to provide moral hazard problems for the international flow of capital. I'm just buzzing through a lot of these things. I hope that's okay. If you want to ask me about them, we'll have plenty of time in a few minutes. Bank-dependent finance. As I said, East Asian corporate bond markets are relatively thin. And I might add, so are equity markets. They get a lot of publicity, like the Shanghai market, but it has a very, very little relationship to the Chinese economy. And so there's excessive dependence on banks for credit intermediation. The problem is that firms benefit from banks. It's true that firms benefit from access to bank and direct finance. And in the United States, there's an option to exploit corporate visibility to bypass information-intensive bank lending with direct lending through the corporate bond market, depending on the circumstances. Turns out that the presence of both options, to borrow through banks or to borrow directly through the corporate bond market, are good to have around. From time to time, one or another of these channels goes down. Right now, and this makes this talk a little bit easier than it was to do in May, because right now, one of the channel that's down is the corporate bond market, the capital market way of getting funds into a company. The short-term commercial paper market in the world is down. It's been contracting. And finance has been moving in the last 3 or 4 months back onto bank balance sheets around the world. We haven't had one of those collapses in a long time. In East Asia, what happened in 1998 was the banking system collapsed, and there was no corporate channel at all, and so that took the whole economy down. My point is that in East Asia, being so heavily bank-dependent, and still heavily bank-dependent, the country is susceptible to a general macroeconomic downturn if their banking system goes down. There's nowhere else to go for intermediation. The point is that actually the people in East Asia, the policymakers, all agree to this, and they've been working like crazy to try to jumpstart bond markets and capital markets more generally. I have a couple of things that happen in East Asia as a consequence of having excessive bank-dependent finance. And one of them, which I don't have a lot of time, but I'll pick one of them on this slide to mention and emphasize. First of all, I'll pick two of them. The banks themselves they lack discipline because there's no competition at the margin with capital markets. And that means the banks in East Asia are not as innovative, and they're not really able to manage themselves as effectively without the competition from capital markets. And also the regulators are hostage to banks. The regulators can't really credibly impose restrictions on banks that would take down the ability of East Asian economies to finance investment because there's nowhere else to go, and the banks know that. So regulators, the way I put it here, are hostage to banking in these countries, and that's not a good thing. And as I say, these points I'm making here are generally well understood in the region. And of course, if you have a lack of financial robustness to the banking system, if a central bank wants to raise interest rates to stabilize against inflation, and the banks are financially weak because their balance sheets are weak, that inhibits a central bank action. So that's also an important impediment to macroeconomic policy because of bank-dependent finance in Asia. I have to say it once more. The authorities in the region are working very, very hard to develop corporate bond markets as an alternative to bank finance. The problem is that it takes time to develop legal frameworks to deal efficiently with bankruptcy and investor protection outside the banking system. And these economies don't have a long history of hundreds of years where these things can develop. They have to improve corporate governance standards. They have to promote self-regulation of debt markets. And they have to encourage financial transparency. The big problem, in my view, here is that this progress requires, and these are words I choose deliberately that are on my slide, breaking monopoly power of the well-connected people over financial intermediation. In these countries, well-connected people run the banks, and of course they don't want to give up their power. So you have a tug of war between people that run the banks that historically have been well-connected in these countries and the robustness of these economies against worldwide shocks. In my opinion, this is one of the most serious problems in East Asia. And you'll see in a couple more slides how it really is a problem in China. I'm going to come back and talk about Chinese banks in a minute. In the interest of time, I'm going to skip this slide, which, as you can see, is fairly technical. There's a few numbers on it, and I don't want to have to go into it. I'll just say this, that if you do theoretically look at the issue of the relationship between the exchange rate, the yuan and the dollar exchange rate, and you ask, what effect is an appreciation of the Chinese yuan against the dollar likely to have on the U.S. trade balance with respect to China? You find out it's very difficult to get the effect that's discussed in the press. This is so counterintuitive that I can't really give you a one-line answer to why that's true in the model. So I'll skip this, and we can come back to it if there's by popular demand, so to speak, in the Q&A. But I want to get past this so I can make a few other points and then get past my introductory comments. Bank reform and the flexible foreign exchange rate in China. As you can see, a good chunk of these slides has to do with China. And the reason is, I think it's fair to say, how China goes, so goes the region. And in a few more years, as China goes, so goes the world economy. Exchange rate adjustment will have little, if any, sustained effect on the trade balance in China, as I just said. But China needs a flexible exchange rate to free interest rate policy, not to affect the trade balance, but to stabilize domestic inflation in order to stabilize domestic employment in China. In other words, China needs a flexible exchange rate for its own good, not to help the U.S. trade balance. The problem is that Chinese banks must be made financially robust to high interest rates that would be needed to stabilize the inflation in China with a flexible exchange rate. Well, I sound like a little like a broken record here. Problem is, Chinese banks are like other banks in East Asia, only more so. They're motivated to direct credit to well-connected borrowers. There's a tendency in Chinese banks to build up non-performing loans, NPLs, with tacit approval of the government. By that I mean, what happens in China is that the Chinese growth miracle is decentralized on the basis of political jurisdictions, say Shanghai. The leaders of Shanghai, the mayors and so forth, they also are heavily involved in running the banks in Shanghai. And the banks in Shanghai have captive savers of the households in Shanghai, which basically are forced to put their savings into the banks in Shanghai. So you have the people running the city and the bankers with plenty of money to distribute, to lend. And who are they lending it to? To connected people. This is not good banking practice. And in the U.S., we've had this problem. We call it a savings and loan crisis. Unfortunately, in China, the whole banking system has this problem. And so what happens is, politically motivated loans happen. Some work, some don't. But the history of the last 10 years is that many of these loans don't get paid back. Again, reminiscent of the savings and loan crisis. And the government has incentive to recapitalize these banks every so often, top them up again with capital after the capital's been lost. And the reason they do is because this is a country that's, just like in the U.S., the government wants to protect the deposits in banks. And it's forced to play so-called after all this happens. The horse gets out of the barn, you put another horse in the barn. Okay. And it's lucky for China. They have plenty of horses. Where are the horses? This last stuff I'm going to talk about. International reserves. Over $1 trillion of horses, so to speak, or dollars, that's owned by China and still accumulating. And what China has done is transfer every so often some of these international reserves into the banks to recapitalize them after the monies have been lent and lost. So that's my picture about Chinese banking. What does it mean for Chinese monetary policy? Well, I'm going to say this first bullet point because it reiterates what I'm saying in a better way than I just said it. Bank managers cannot be asked to lend prudently with an expectation that loans be repaid and capital preserved when managers are rewarded by a political system in China for directed credit to connected borrowers or state-owned enterprises. And then these managers are excused for making bad loans. That's the problem in Chinese banks. Problem is, the depleted capital going forward weakens the bank's robustness to interest rate actions against inflation. One of the reasons why Chinese deposit rates are I think they're running 3%. I haven't checked recently. Inflation in China is running about 6%. Chinese deposit rates are about 3% or maybe 4%. They're below the rate of inflation. Chinese households are forced to put money in banks and to lose money at a real rate of return that's negative 1 or 2%. And that's because the banks are weak financially. Now, I've worked on this problem with a co-author of mine at the International Monetary Fund, and we believe that there are opportunities for China to put in place in a relatively few years, at least this was true we wrote this 3 years ago. I think they're making some progress, but it's not completely clear to me how much progress is being made. Anyway, there are reforms that can be put in place to blunt the incentives to accumulate non-performing loans on the part of banks. And I would say that if they can do that, then China can think about floating its exchange rate, and instead of anchoring monetary policy with a fixed exchange rate, it can anchor monetary policy, as we do in the U.S., by stabilizing inflation, occasionally moving interest rates high. They can't do that until they fix their banks. They can't fix the banks until they kind of work out what to do with respect to politics in banking. And you can see that banking, exchange rate policy, they go right to the heart of how the Chinese country runs itself with the Communist Party in control. Well, I think I'm going to stop here. One way or another, I've gotten to talk about international reserves, and I'd rather have some time for Q&A. So if there's no questions and answers, or answers, I'll have some answers. If there's no questions, I'll be happy to continue, but I'd rather not. I'll just leave it there. Yes?
Can you elaborate on the impact of the U.S. as far as China? You mentioned that, we can talk about that a little later if there is interest. But,
About what?
I think you said what's widely distributed in the press is not what you'd expect to happen.
With respect to the trade balance?
I think it was a trade balance, or was it?
Yeah. Okay, I'll give you I'll try my couple of sentence answer to that. Since you've asked, I'm setting the bar a little lower for my answer. So, suppose the Chinese currency appreciates relative to the dollar, it's true that will improve the competitiveness of U.S. exports in China, no question. It'll tend to make U.S. residents want to buy less Chinese goods and more U.S. goods, and it'll tend to make world residents, including Chinese residents, want to buy U.S. goods instead of Chinese goods. And so an appreciation of the yuan against the dollar will be a good thing in that regard. But to the extent that the real income of U.S. residents depends on cheap Chinese goods, the real income that we have will fall because our purchasing power over Chinese goods will collapse. And it turns out that these two forces exactly offset each other in the first model you write down where you try to do the math. In other words, we're buying a lot of stuff from China, and U.S. real incomes are high because Chinese goods are cheap. It turns out that if you make those goods more expensive, the substitution effect will help us in terms of competitiveness. But the income effect, the negative effect on U.S. income in buying power over world goods, will go in the opposite direction. And there's an important caveat, to the extent that the U.S. Federal Reserve continues to stabilize inflation in the U.S., regardless, these two other effects exactly offset each other. And so you have to go to a second level of thinking about world affairs in order to get the presumed effect on the U.S. trade balance as a result of a yuan appreciation. That's the best I can do. That surprised me. I mean, after I wrote this paper where I kind of worked this out, I found out that there are 2 or 3 other places that people have worked this out too. So the question is, what do we need to do to elaborate our models to match what people believe is true in the real world? Our models may be wrong, and all I can tell you is that so far I cannot say conclusively that I believe the intuition that seems to be floating around about this. The main benefit for appreciating the yuan is to stabilize inflation in China. And the main benefit for the U.S. is that if China can stabilize inflation, they can stabilize growth. They can maybe avoid this boom and bust cycle, which is going to boomerang back on us. But it's hard to make the direct case for an improvement in the U.S. trade balance. Yeah.
Somewhat along that same point, there's obviously been tremendous pressure on world commodities like concrete, steel, copper, what have you, with construction movements and growth in China, where we build a new city the size of Manhattan every 5 years, or 5 minutes maybe. But if the yuan was appreciated obviously a lot of those commodities would become that much less expensive for them to import. Can that result in, actually some significant inflationary pressures in the U.S. economy?
So what you say is absolutely true, but the flip side is the dollar would become less valuable around the world, and there would be inflationary consequences of that for the U.S. So the other things we buy will become more expensive. And it turns out that those effects more or less cancel each other to a first order. I mean, we'd have to go and look at the details of the mix of the two sectors' effects. But as you know, a depreciating dollar in general can be inflationary in the United States unless the Federal Reserve reacts. So what most likely would happen, I don't know which direction the first order effects would occur, but if they actually did, no, I better not speculate. I'm not going to, even if I had chalk, I couldn't do a good job.
It would seem that the prices of those commodities are rising more because they become much less expensive and then they buy more of to continue the construction.
I'm not, I think you're absolutely correct. I'm just saying that there are these countervailing effects on U.S. inflation coming from the collapse of U.S. essentially the collapse of U.S. buying power of the dollar elsewhere, and other countries' currencies would follow the yuan. The very interesting fact is, or very interesting issue is, if the yuan were to appreciate big time, what would countries like Japan and the neighboring countries in the East Asia do? Would they follow China or split the difference? We really don't know, and that's a big wild card in this. Because if they all followed, then the dollar would really take a nosedive in terms of purchasing power. Yeah. I'll get you.
I mean, this is sort of what effect would the appreciation of the yuan do in terms of just the wealth of dollars that they're holding right now? Do you think that's going to free up some of them?
Well, it would free up a lot of them by depreciating their value. I mean, freeing up is a very nice word for something that would make a huge capital loss. They have $1 trillion of dollar assets, roughly thereabouts, very roughly. And their valuation in yuan, would collapse if the yuan appreciated against the dollar. It would be a way in which the Chinese had taken a huge capital loss for having taken what's called an open position in U.S. assets.
But that's continuing to build, but at some point they want to stop that or at least turn it in the other direction. So it's appreciating the yuan a way to correct that.
Well, I mean, it's a way to recognize the losses on their portfolio. I mean, if you want to call that a correction, I guess that's okay. They are not in the China. I think it's a mistake to think that the Chinese enjoy accumulating foreign international reserves. They're caught because their banking system is so weak that they have to fix their exchange rate, and they're kind of forced into accumulating international reserves to balance their economy. I'll give you a short 2-sentence story about the way I like to think about their accumulation of reserves, and then we'll come back to the comment you're making. China doesn't have an independent monetary policy because its interest rates are too low and the banks are weak. And yet it's got a ton of saving going into the banks in all these cities, which is then kicked out the back of the banks in loans that I was describing. Well, how is the country going to sort of manage investment? If any of you have been to China, it looks like you were in a time capsule and you dropped it to the end, Europe in 1945. There's so much investment going on. There's so much rubble around. It looks like the country had been recently bombed and lost a war and is rebuilding itself. And no exaggeration. It's even more so than I can characterize. So the country knows that it has to divert these savings away from investment. Its people won't consume so much. They're a little nervous about the future. The authorities are saying, please, people, buy things. And people are saying, no, we'd rather save. Why? Because they're not quite sure this country is going to make the transition over the next few years. It's a good idea to save if you've been living on a low level of consumption goods for a long time, and you can handle another 5 years of that. But the authorities want to replace investment with consumption. They can't do it. So the alternative is, this is what they're doing. The People's Bank of China literally issues something equivalent to certificates of deposit and takes these certificates of deposit and and sells them to the banks in China, so that the Chinese, instead of lending money to their citizens in the cities, they can lend money to the People's Bank of China in terms of what we call People's Bank bills. What does the People's Bank of China do with money that they have borrowed from the banks so that the banks don't invest too much in China? They lend it to the United States by buying international reserves. When you think about it this way, this is the kind of thing that makes my hair stand on, and I love being a macroeconomist. When you cut through all this stuff, this is an outrageous situation. Now, here's a developing country which is lucky enough to have people save like crazy, and actually has too much saving for the amount of investment that's consistent with price stability in China. And what do they have to do is they have to, through this surreptitious mechanism, lend this money to the U.S. so that we can consume more than we need to consume. That's what international reserve accumulation is all about. They're not happy with it, we're not happy with it, and the root of the problem is that the banks are very weak. Good question, thank you.
A lot of these things are like Japan maybe 10 or 15 years ago, in the sense that there's a high savings rate, the banks, the corporations, and the government were all together, and they were trying to bail out some of these companies that obviously were not viable. Is that right?
Exactly. I would sign on, not in the details, but I would certainly sign something if you want me to sign on that. Japan is an East Asian country, and these countries have in common the fact that they developed in the industrial sphere much faster than their financial sphere. For us, we were lucky. The two kind of developed together over periods of hundreds of years. And so, yes, Japan has had that problem and still has a weak corporate bond market and a bank-dependent financial system. The main difference is, of course, Japan, well, for reasons that are peculiar, it was already developed enough so that it could get quite far before the banking crisis in 1990. China has not been so lucky. Well, okay, you had your hand up first.
On one of the slides, you actually touched upon how banks are, sort of, they're influenced by well-connected people, and they tend to lend to such well-connected people. And this kind of monopoly has to grow. Are there any suggestions as to how this can be achieved, or is it something of an internal policy decision that they need to make in Chinese from the government side?
How? What can be achieved?
This kind of monopoly that banks tend to lend only to well-connected people.
In China?
In China.
You're asking how that happened?
No,
how it can be overcome?
How it can be overcome.
Oh, that's the $64 million question. We had a quiz show. When I grew up, there was a show called $64,000 Question. I'm sorry, I gave away my age there. I think it's now called $1 Million Game or something. Anyway, but that's the big question. The question that people who understand what's going on in China have is, how can the banking system be disconnected from the political system? Because you need to, as you're suggesting, this is the key knot that needs to be untied in order for China to stabilize itself and move forward. And it's not clear, completely clear how to do that. We have some technical reforms that it's easy to see that need to be done to do that. At a technical level, you need to have the banks sold to private interests who have the incentive to manage banks to take care of risk and protect capital. And so it's easy to see technically how to do that. The problem is, if you do that, you're going to knock, you have to think, what's going to happen to the members of the Communist Party who are now in a position to take advantage of this connectedness? But there's a bunch of ways you can imagine this. You can sell the banks to the members of the Communist Party which have rights to running them now, and that would make it work because then they would protect their own money to the extent that they weren't able to count on bailouts from Beijing, which might be difficult. Or you could invite foreign investors in to invest in Chinese banks and bring with them foreign direct investment on how to evaluate credit and so forth, and let the banks be run more and more on a commercial basis. If you do the second, you're going to shut out the political interests in China and could create some backlash. So in the first case, people who are not in the Communist Party are going to be upset because members of the Communist Party are going to get a benefit of this. And in the second case, the Communist Party itself will be upset because they're going to be cut out. So you can see that this is a very delicate road to travel to try to disassociate banking from politics in China. And it's even worse because China needs to have an off-the-shelf rule of law property rights system in place in order to make this market system work. It doesn't have that yet. What it has is, if you're doing business in China and you have a partner or in some link to the Communist Party, you're protected under the system because you have an advocate in the system. If the party is weakened by moving it away from banks in some way. The country needs to find a substitute, property rights protection, to continue to encourage foreign direct investment and to continue to encourage growth. So this is a hugely difficult problem. Now, having said that, no one would have expected China to do as well as it has in the past 30 years. The people who run the state council in China, who run the country, the 30 or so people, or whatever, however number it is, run a country of 130 million people, doing a pretty good job. And I wouldn't want to bet against them. Yeah. I'll get you.
China is now open to international banks, and also Chinese banks also go to the stock market in Hong Kong. So what's the impact of this on the Chinese banking system?
Well, the comment on what's the impact of foreigners investing in Chinese banks on the banking system, it's altogether healthy for the reasons we were just discussing. And it's one of the ways in which the government in Beijing is trying to rationalize banking within China, in a very important way. How far they're willing to let that go is another question. You read in the newspaper, they're always stopping short of control. And you know, the foreign investors are willing to put money into China because China is likely to grow, and they're happy to get in order to get in on the ground floor. At some point, foreigners are going to demand some more control over the banks, and the government's going to have to give it to them. But when they do, they're going to get kickback from the local interests who run the banks now. And you can bet that that's the main trade-off in what they're trying to do. Trying to have it just so they can continue the whole process moving forward, give a little to both sides. Yeah.
I'm just starting to learn about economics, so probably a very basic question. Trade is typically based on competitive advantage. That's what we always start, right? But over the past 20 years, or maybe 25 years, trade, as we see it, is based on convergent rate differences, arbitrage, for example. So it's not necessary that China or India are competitively more better positioned to deliver the goods that US can't produce, but they are better positioned because every dollar fetches 45 rupees or so many yuan. My question is, I mean, on the one hand, we are worried about Chinese coming under deflationary pressure, or maybe we're also then worried about Chinese economy, and then we are at the same time worried about if Chinese yuan appreciates, US is going to lose its buying power because the dollar to yuan arbitrage will be deficient. So what I'm thinking is, what made us, on a macro level, what made us support this kind of a trade without imposing? It would seem to me that export from those countries, if it's being done only at the cost of arbitrage, should not have been done, or maybe should have been given a handicap, for example. Maybe because I'm thinking US has lost a lot of manufacturing ability. US has lost a lot of information systems processing. Enrollments in universities are down. People don't want to go into those fields anymore, and we are thinking we are rising high up in the food chain. Whereas I think, in my opinion, we are losing core competencies, which are going over to other countries and only based on arbitrage. So I'm thinking, I mean, why aren't we doing anything to counter it, or why did we not do anything to counter it? That's been my basic question for a long time.
Yeah, well, that's a great question. It's the big question. It's almost as big as this one. It is the big one for the U.S. The other one was for China. The problem is that the U.S. is coming off a period of 50 years of extraordinary preeminence in the world economy. It hadn't been seen in world history. There's no way we could have remained at that precipice. And it's very hard for a country to come off a period like that and sustain self-confidence. But the alternative of trying to wall ourselves off from that is disastrous, because it's going to happen. You know, the future is going to lie in Asia in terms of the composition of income produced on the planet Earth. The U.S. produces maybe, 25 or 30% income now, and it's going to fall radically. And so our country, the U.S., has to deal with the fact of life that it needs to find a role for itself in the world while these other countries are emerging. We might as well deal with it now than fool ourselves that we can sustain an independence in the world and feel secure in the world in 50 years by walling ourselves off from cheap goods from Asia. My feeling is that, and I will add another thing, this isn't the first time in the world when the leading economic power has felt threatened by the up-and-comers. In fact, Britain was the leading economic power, in the Industrial Revolution, and it was threatened by the United States and by Germany and by Switzerland, but that's so small nobody cares. So. And so Britain, what happened to Britain? A total collapse of self-confidence in the 20th century, and didn't really reemerge until Margaret Thatcher. I'm afraid the U.S. may have to suffer that same kind of collapse of self-confidence in order to reemerge. But Britain has reemerged. It has no empire, but it's the strongest economy in Europe. And it's reemerged in those industries which it found that it could do well in. And it's just fine. You know? I think that the U.S. will be just fine. We might as well deal with this issue head on. It's not going to be easy, and we can talk about this offline. But I'm definitely not in favor of walling ourselves away off from this sort of thing. Yeah, thanks. Good question. Yeah.
Now, to build on that question, is there any other reason the Chinese government gives for holding this position on not changing their not devaluing, not appreciating their currency?
Is there another reason?
Another reason is, one reason could be that, one reason I'm thinking is that they want to make the Chinese goods as cheap as it is, and they want to promote this, they don't want to lose this edge. Is there any other reason? What I'm thinking of is, there is, to your point that Chinese banks are controlled by a few people. If the rates fluctuate, that would cause more instability in China, just because of that reason.
If interest rates fluctuate?
If the Chinese yuan
oh, yeah.
fluctuate.
Well, I mean, so that's a fair question, because I haven't really talked about this. It's a question about maybe what's the arguments for fixing an exchange rate rather than letting it fluctuate. And so to support your point of view, I will say that if you travel around in Asia these days, and I just got back from India, what's the big issue? The rupee is appreciating like mad. And the government is under heavy pressure to stop that appreciation. The Indian government is trying to stabilize inflation, and the central bank has raised interest rates to do so. I happen to think that's the right policy. But you're right, there's stresses all over India because they're being priced out of export markets relative to China and other countries. This is, and that's not only happening in India. You travel all around the region, and exchange rates relative to the dollar that are free to float have been appreciating like crazy. We're having a test of this, whether or not these countries can sustain in a political economy way policies directed at stabilizing inflation while letting the exchange rate appreciate. I favor that in principle. I don't know whether it's sustainable in the political economy context. Having said that, I want to come back to China's reasons for floating its rate. China sees these other countries, and they are not excited to try to have their rate float way up either. On the other hand, China also sees the pressures of having a monetary policy that's exploding domestic price inflation. To get back to my very first slide, China can't help it. Its real exchange rate, the real purchasing power of Chinese people over American goods is rising rapidly because this is a fantastically developing country. They have their choice. They can let their exchange rate appreciate, or they can have domestic inflation. They have no choice to stop both. And they're trying to have it both ways. They basically understand that they would like to have a Federal Reserve-like monetary policy. The way I got involved with China in the first place is that my co-author, Iswar Prasad, who was head of the China department for 3 years in the IMF, was over at the People's Bank. This was like 4 years ago. And they said to him, we would like you to write us a paper, a framework for how we should do monetary policy. And he told me, he involved me in this project for the following reason. The Chinese said, we don't want you to think of us as a developing country. We want you to think of us as a country like the United States. And we want to know what we should do if we had a Federal Reserve in China. And the paper we wrote was, okay, stabilize domestic inflation and let your currency float, just like the U.S. And we wrote that paper, and it hasn't been universally endorsed, but it's been endorsed by many people on this debate. So the Chinese are very, very conversant in these issues. They're trying to kind of thread the needle. They understand the risks on both sides. In the end, I think they're going to have to float their currency and take their chances that way. Yeah.
So do you think that the transparency involved in India and the United States regarding the political situation, you don't think that that's a concern for them to hold on to that for their policy? The transparency, meaning in India and the United States, there is a lot of transparency in government policies from the people's perspective, point of view. But that I don't think is the case in China.
No, China has more or less totally opaque policies, with very little transparency. Yeah. Which way are you going with that comment? I think I agree with you. But
is that a reason for them to continue with their policy of not letting?
I think that's a very, very perceptive idea. So just very briefly, China is run by one party. And transparency is not a feature of the way they run the country. And you're right, if they were to move to a monetary policy like used in the Federal Reserve, and if they would do the kinds of things that I'm talking about that they need to do to be compatible with a market economy that they're developing, they would have to become more transparent because they're not telling people what to do anymore. We don't tell people what to do in the U.S. The governments are transparent about what they're doing so people can make the decisions in their own interest. And you're absolutely right. The Chinese are not willing to take the step yet to move the markets, to make markets, the exchange markets, more flexible enough to the point where the government would have to become more transparent about what it's doing because it's not comfortable that way yet. Now, I don't know why. We're not privy to the discussions of the 50 or 100 people who run the country. But you can tell, and your question is very perceptive. This is a major, major hurdle that the country is going to have to decide to undertake if it's going to succeed to move its country into what we would call full market economics. Okay, I'll come back to you in a minute. Okay.
I don't have precise statistics, but I think that the majority of China's international reserves are in U.S. government securities. So how likely do you think is for China to start diversifying their portfolio, and what will be the implications for the U.S. if they do this?
Well, good question. The question is, how likely is it that China will diversify their portfolio away from U.S. Treasury securities? Last I looked, it was maybe 60 or 70%, and it's come down a little bit. They're not going to do it with a big splash because they don't want to have people selling out in front of them. So if they do it, and they are doing it, they're doing it quietly and slowly. They probably, and so they're doing it in a couple of ways too. They can move out of U.S. Treasury securities and into U.S. corporations, other U.S. assets, without changing out of the dollar. And that would be a viable thing to do in the way of diversification. I don't believe that China, let me put it this way, I think China recognizes that it is a necessary condition for them to continue to develop, I think for the next maybe generation, that the U.S. economy remains strong. There's no question in my mind that China and the U.S. have a major strategic dependency on each other, and both countries recognize it. And you give me a chance to make another point. I think my experience in all this is that the leadership of both countries has more in common with each other than it has with its own public. And I say that, and this is the most serious issue facing the world economy. In the U.S., people are entertaining the idea of putting up tariffs against Chinese goods. And we could very well have people in the majority in the U.S. government in the next 5 years willing to put tariffs up against China. On the other hand, in China, we were describing a minute ago, we have problems between the party, kind of a jealousy between party members and other people in China who aren't as well connected. And I didn't mention this, but I'll add another problem that China has is between the rural people and the city people. The rural people have not got the right to own property, and the city people do, in effect. And so this is becoming a ever more serious matter in China. There's hundreds of millions of people who are in the farmlands who would love to own their own land, and the government in Beijing has not allowed them to own their own land. And yet, when foreigners come in the country, they get an implicit guarantee of ownership. When people tell me, and you may know more than I do, that if you buy a flat in an apartment in Shanghai, you get a 75-year lease or something. Farmers don't have any such thing on the land that they farm. So the problems with the world economy are really about stresses between the leadership in the countries and how to manage its own populations. And to the extent that these populations get restive and create problems for the leadership, we have a real problem in the world economy. Right now, the leadership in the two countries is pretty much on the same page. So they're not going to sell out their portfolio and hurt the dollar, I don't think. Yeah. Long answer to a short question.
Just to continue the point that you just made, when you look at the history of Russia that went on for 7 years with run by one government, one party, no transparency, no rule of law, no property ownership, and ultimately it imploded. Isn't China inevitably going in the same direction? And I don't know if it's next year or 30 years, but how can it continue? You can't suppress people that long without some effect down the road.
Well, I have a lot of sympathy with that comment. And if I had to come against it, I'd start with this. China's lucky. The communists took power in 1949, not 1917. And that's a big, big difference. That's 2 more generations that are closer to the human capital that was in the country before the Chinese communists took power. I think that's a big, big difference. Secondly, the Communist Party in China has seen this disaster in Russia, in Russia's, the collapse of communism in Russia and the moves toward a market economy. And at least they're not going to make those mistakes. You're right, that doesn't mean that China can make this transition successfully, but they have the advantage of having seen things go wrong elsewhere. A third thing, I think, is that China is more isolated than countries in Europe. And China has the capacity, I think, to manage this isolation for a little bit more, which is to say it can maintain capital controls potentially a little more easily than other countries. It has the capacity to use, well, this is not, it's not going to, it has the capacity to hold on a little bit more, a little bit longer with respect to sort of a controlled economy as it lets parts of the economy evolve. Now, of course, that's only a temporary thing. That can only last 10 more years, maybe. But it has some time to play with. So I wouldn't want to count them out. But I agree with you. When it comes to these issues we're talking about here, it's not at all clear to me they can make the transition to off-the-shelf property rights, rule of law with a judicial system that's independent, a country with genuine banks that make loans on the basis of commercial creditworthiness. These are all things which have to happen to make a market system viable. Right now, I think they're shocked by how vibrant their market system is. I think they were overtaken by what happened when they liberalized the country. They won't admit this, but I think they're just absolutely amazed at how China has grown over the last 20 years. And things have moved faster than they were prepared for. So they have to catch up in the public policy sphere, or I agree with you, they're going to have a problem. I'm not willing to say on camera what my odds are. I'm not very happy about these podcasts that get broadcast all over the world, but afterwards I'll talk about this. Let's see. So have I not gotten anybody? I'm happy to go back to you too, and maybe we should call it quits after that.
You touched upon a little bit about the inflation targeting. Can you say pros and cons and elaborate your view?
On the general issue?
Yeah, general issue.
Oh, I like that. I'm a huge fan of inflation targeting, and, you know, and I can give you views on this from theory, from history, and from practice. There really is no alternative. You know, to give the short answer to the question is, a monetary policy needs to have a nominal anchor, and you can choose there are like 4 candidates for nominal anchors. Gold standard was a nominal anchor. It's not going to happen. You can choose a money growth rule. The central bank simply sets the quantity of money on a path and doesn't do much else. That's a nominal anchor that's viable, the one that Milton Friedman advocated. That's not going to happen either. It can fix its nominal exchange rate against a trading partner and import monetary stability from the trading partner, but we see it's very hard to do in this world because of capital flows and because the world is in tumult. And that leaves you with the only nominal anchor that you have, which is still viable, which is a domestic inflation target. So really it's by process of elimination that I like to make the case most broadly. But I would also be happy to give you chapter and verse in the theory that matches up with the practice and matches up with historical experience with other nominal anchors or with countries trying to get by without a nominal anchor, which is even worse.
But why is this reluctance of going to that policy of, stating what the inflation target is?
In China or in the U.S.?
In the U.S.
Oh, okay, yeah. Oh, yeah, no, I know. You trapped me into a good question there, yeah. So the question is, well, if it's such a great idea, why doesn't Ben Bernanke come out immediately and say the Fed wants an inflation target and we're going to do it? Well, how would I put this? The most straightforward way to answer this question has to do with the institutional. I should say, by the way, there are 20 countries around the world or so that have an inflation target that's explicit, in which the central bank and the government have agreed to an explicit number, and everything works fine. The U.S. has what I've argued in earlier work as an implicit inflation targeter, and I have said this, so I'm willing to say it here. We have a don't ask, don't tell monetary policy. The Congress, who has oversight over the Federal Reserve, never asks the Federal Reserve, what's your strategic priority for monetary policy? Is it inflation or unemployment? Well, the best practice is it has to be inflation for various reasons. The Congress never asks that direct question to the Fed, and the Fed never volunteers that. That's its strategic focus. So we have in the U.S., as in many other parts of U.S. policy, a don't ask, don't tell equilibrium. I'm not happy with that. I'm just not, maybe I'm naive, maybe I still live in the world of high school textbooks, maybe I'm so wedded to history that I really believe why we have a U.S. Constitution, which was that the Founding Fathers said, well, you know, in future generations, hopefully, our countrymen will never experience tyranny. So we need to remind them of what happened in tyranny so that they don't go astray. And therefore, we're going to take years or months to write a constitution, have a Bill of Rights, and so forth. Hopefully, we won't have inflation in the country in the future. But I'd like to kind of nail that down with some words. I don't like don't ask, don't tell. You can imagine why we haven't moved forward on this is because the Federal Reserve is a creature of Congress. Congress can dismember the Federal Reserve and change its organization with a majority vote of Congress by changing the Federal Reserve Act. It's not a very secure situation for the Federal Reserve. And so the Federal Reserve is in an equilibrium, a political equilibrium with the Congress and with other political issues that it's not fully in control of. And so when you think about the tactics by which the Federal Reserve would make the case for an explicit inflation target, it becomes a little difficult. A lot of people are afraid that if the Federal Reserve were to bring this up, the Congress would say, well, we also want a target for employment. And that's not feasible. No, we as experts know. So it's a delicate matter. Effectively, you have in the United States people in Congress who have the final say over monetary policy who are not experts in monetary policy. And it's hard to know what the best strategy is for experts in the central bank to undertake to move monetary policy forward. That's the best way I can answer the question. I'll talk to you later, too.
Great. Well, let's thank Dr. Goodfriend for his insights this afternoon.